Welcome from me, Guy Monson, to our regular 6-Minute Strategy. It seems as if the deflationary forces emanating from China's property market have finally got the attention of President Xi and the country's leadership. The Chinese authorities have responded on three fronts: cutting interest rates and bank lending ratios, issuing loans to support stock buybacks, and promising fiscal stimulus. We estimate the fiscal stimulus program could amount to about 1.5% of GDP on what we know now. And while this is significant, it's still a far cry from the 27% of GDP spent in stimulus in the wake of the 2008 financial crisis. The question then for investors is whether this in fact is just a de-risking step by the Chinese, or is in fact the beginning of a larger and more determined stimulus program. We lean toward the former, seeing these steps as welcome, but noting that they still lack significant measures to boost consumption. In the meanwhile, Chinese exports continue to soar, with September seeing the largest shipments of cars and ships on record. Much of this is destined for foreign markets and will put huge pressure on local producers. Indeed, it's already triggering a round of tariffs in response. We'll discuss all of this in more detail with my colleague, Dr. Subitha Subramaniam, in the slides ahead. So welcome, Subitha, back to 6-Minute Strategy. It's wonderful to have you here. Our topic today is China, and in particular property-led deflation, and of course the implications for global tariffs of this export boom we're seeing from the Chinese economy. Talk us first through what the growth picture looks like.
So China's been decelerating very sharply since the rebound after the economy opened up at the end of last year. And I think what we've observed is that nominal GDP is growing lower, is coming in slower than real GDP, which means that the economy is experiencing pervasive deflation, which is an incredibly difficult environment. If you have a lot of debt and your price levels are falling, it really becomes difficult to pay back your debt. You actually have a huge solvency issue across all parts of the economy that are leveraged.
Particularly local government.
Yeah.
Yeah, I see that. And on the right-hand panel, we've just compared corrections in real estate markets in China to those elsewhere in the world, US back in 2006, Spain in 2017, and Japan, of course. And we're beginning to smell a little bit of this possible Japanification of the Chinese situation going forward.
Yes, and I think the real issue here is that Chinese households have a savings rate of roughly 40%, and roughly 20% of that has gone into the housing market. And as Xi Jinping has tried to divert capital away from the housing market, it's finding itself everywhere else and expanding capacity.
So we got news at the end of last month on the stimulus package. It's pretty substantial in many ways. They're cutting reserve requirements, central bank rates, injecting a lot of new capital into the banks so they can continue to loan, helping the highly indebted local governments buy back or deal with unsold homes. They've got a fiscal package of 1.5% of GDP. That's not nothing, but it pales into insignificance compared to the almost 25% of GDP that we saw after the financial crisis. And of course, they're supporting the stock market a bit. Is this enough for you, or do they need to really target the underlying consumer to get them back in the shops and spending?
So I think there's good news in terms of what China has done. The first thing is that they've recognized that we cannot have deflation and the property market really losing confidence at this pace it was losing. So I think it's really helpful to stabilize sentiment. The measures are quite comprehensive. They range from banks, state and local governments, to households and the property market. So I think they will help arrest the sort of spiraling downward confidence in China. They're also aimed at shoring up the balance sheet for banks and local governments. So this will really help the Chinese government push through monetary and fiscal policy to the end consumer.
Common prosperity, the great word, and this idea that the new productive forces of technology and the industrialization of China are really where Xi wants to see the growth.
Yes, and I don't think they have really stepped back from their overarching aim, which is really to, in the long run, shift the economy from what they view as unproductive investment in property towards manufacturing, and really become the global manufacturing sort of center for all of the world.
Well, you could see this in action, this extraordinary chart we've looked at before on this session, this surge in Chinese auto production from really a bit player just 8 or 9 years ago to exporting 5.25 million cars. September was the highest number of autos ever exported, and we're seeing now this in batteries, in solar panels, in EVs, in ships. The list just goes on and on and on, and that is putting enormous pressure on the domestic companies of countries outside of China. And I know your worry is this will lead to a surge in tariff talk, and of course we heard Donald Trump last night say, to me the most beautiful word in the English dictionary is a tariff. Is this a tradition for the US?
Yes, so I think we should not forget that the US has been very comfortable using tariffs as a way to raise revenue. I think in 1890, William McKinley was the president of the US, and he is Donald Trump's favorite American president, and he put in place tariffs as high as 50% for most imports coming into the US, and tariffs constituted roughly 50% of all federal revenues. Obviously in the post-war era, we've seen, the dismantling of these tariffs across the world, and it has coincided with a period of really great prosperity.
So if you take the right-hand side of that chart, Trump's first tariffs there, you would think that if he's got a historic context in mind, tariffs of, say, 20% for the rest of the world are not unprecedented in US history.
Yes, and I think as his interview recently just hinted, I think that is the framework that he is using, which is to use tariffs to fund the government and bring production back into the US.
So let's briefly wrap this up. First of all, I think the stimulus program in China is good. It does stabilise global growth, and it must be welcomed, and it's good for global earnings in that respect. In the medium term, though, it will trigger tariffs. We've already seen the EU moving. That means we need to focus on national champions, companies that are within the walled garden that can benefit, particularly in the US, from domestic growth. Thirdly and finally, keep your eye out for any sector that touches China directly, because those imports are so super competitive, despite the tariffs, that they risk undermining margins and shareholder returns. So Subitha, thank you again for joining us, and those insights on tariffs are fantastic. For the audience, we are just under 3 weeks away from the US elections, and we'll keep you well posted here on 6 Minute Strategy. Thank you.